Hey everyone, Richard Norris here, and in today's video I'm going to talk to you all about how to avoid and offset inheritance taxes as a property investor. Now, many of the clients that I work with are high net worth individuals, and one of the biggest issues we face as property investors, especially as we grow and scale the property portfolio, is that we face inheritance taxes at the end of up to 40%. So that means on every £1 million of growth that you have with inside your estate as a property investor, £400,000 of that you're losing on inheritance taxes straight away. Now, as I'm sure you'd appreciate, that's not the most strategic way and the most efficient use of our money, and effectively it's something that we want to know how to avoid. So one of the things that a lot of people do, and one of the most common misconceptions that I want to talk about today in today's video, is all about the use of a normal trust. Most people are told by independent financial advisors that we speak and consult with that the way to offset inheritance taxes as a property investor is to put their properties into a normal trust. Now, whilst this does definitely help shield from things like divorce settlements and asset protection, it's not actually the best vehicle for offsetting inheritance tax in the long term. And there's many reasons why, and I kind of want to cover that and elaborate on that as we go through this video today and explore with you and show you, or inform with you is a better way of saying it, of how you can actually set up alternative vehicles via the use of what we call family investment companies or smart company structures with a discretionary trust, which is going to be a much better long-term vehicle for offsetting inheritance taxes as opposed to putting your properties into a normal trust. So let's start, what are the biggest problems with putting your properties into a normal trust, even if it does solve your inheritance tax problems? So one of the biggest problems of putting your property into a trust is that trusts are taxed at the higher rate. So when you dispose of a property as a property investor, you pay capital gains tax. Now, the higher rate capital gains tax is 28%. So if you were to dispose of your asset within a trust, you're going to pay the higher rate at 28%. So the first thing I want you to realize is that trusts aren't tax efficient from the point of actually selling and disposing of the asset, because you're still exposed to the higher rate capital gains tax. And the other problem that you face is income tax. When you want to withdraw money from a trust, so the money that maybe, if you have a property in a trust and it's making you money from the rental income, therefore you might want to draw that money into your own personal name to get the money out of the trust as one of the beneficiaries of the trust to receive the income from the trust. There's two ways you can take the funds, but the thing I want to explain to you before I go into the two ways to take the money from the trust is that it's taxed at the higher rate again. So income tax in the UK as a high rate taxpayer is at 40%. So if you wanted to extract money from the trust, you'd have to pay the higher rate income tax at 40%. Now, there is an argument, or there is a vehicle or a way of getting money out of a trust without declaring it as income to yourself, which is basically borrowing money from the trust. And you could borrow money from the trust as a beneficiary, but the trustees would have to be able to come to an agreement that you could basically borrow that money from the trust, but the money would have to be repaid back to the trust. So you'd have to have a mechanism and be able to repay the money back to the trust. And I believe that HMRC has a certain time frame in which that if you borrow money from the trust, i.e. take it as a loan to yourself, in order to avoid the tax avoidance and what HMRC would deem to be tax avoidance, to avoid the income tax on extracting the profits from the trust, then the loan would have to be repaid back to the trust in a predetermined or a specific time frame. So trusts aren't tax efficient. That's the first thing I want you to understand. From an income tax point of view, from a capital gains tax point of view, a normal trust is not tax efficient for property investors, which is one of the reasons why I don't recommend, if you're thinking about putting a property into a trust as a property investor just to offset inheritance tax, that actually there are other negative nuances that you might want to consider before doing so. The second thing, what else is a problem with putting property into a trust? Well, most mortgage lenders, when you want to take out a loan against a property, they won't lend to a normal trust. And one of the main reasons why a lender doesn't like lending to a trust is because they feel like in a repossession situation that their first legal charge is basically at risk, and therefore most lenders don't allow you to borrow on a property that is in a normal trust. Now, there is one company that I know of, to the best of my knowledge, as I record this video, is a company called Castle Trust Fund. Now, Castle Trust Fund will allow you to put a mortgage on the property, but there may be other nuances that you face. For example, you might have to have a lower loan to value. So as property investors, one of the things that we like to do to maximize the leverage of our growth is to take out loan to values at 75% if we're really looking to scale. So if you're looking to scale, one of the disadvantages of having the property in a trust is you can't actually maximize your borrowings or leverage against that property, because you might be reduced on the loan to value based on the lending criteria of actually having that property in a trust. And the second thing is actually because that there's a very small number of lenders on the market that would actually lend to a trust, such as Castle Trust Fund, the interest rate that you'll pay is very, very expensive. So let's say, for example, right now, with the base rate being around 5.5% in the UK, and a normal mortgage might cost you 5.5%, 6.5% on a buy-to-let. If you had the same property in a trust and you had to use somebody like Castle Trust Fund, you may end up paying 8 or 9% on the same loan. So it's a very expensive way if you want to borrow money and leverage capital. Again, another reason why we don't advise it. That's why most people who end up using a trust as the vehicle to offset their inheritance tax on their property investments is they would only ever do it if the properties were unencumbered, i.e. there was no loans or debt on the property or no mortgages. Okay, so that's another reason why I don't recommend that you use a normal trust. Now, the last reason, and one of the main reasons why I don't advise the clients that I work with, if they have an inheritance tax problem on their property estate, is to put it into trust, is because actually one of the biggest issues that you're going to face is that you have a tax surcharge. So on a typical normal trust, on the 10th anniversary of the trust, you end up paying a 6% tax surcharge on the value. So for ease of maths for the recording and for people to understand, let's say you had £1 million of property in that trust and there was no debt on it. So it was £1 million of property. Well, on the value of the trust, value in this example, the trust is valued at £1 million, you have a 6% surcharge, which is £60,000 of a tax liability every 10 years if the property stayed at £1 million in value. Now, of course, one of the reasons why we invest in property in the first place is to experience capital growth over the number of years that we invest in that property. So in 10 years time, if the value of the property today was £1 million, and in 10 years time, there's this whole cliche that people talk about that, every 10 years your property price will double in the UK. Whether that's true or not can be up for debate, can be up for question, but for this example, let's say that it did. What that would mean is that in 10 years time, the value of the trust now from the capital growth, it's not £1 million anymore, but you've got £2 million. Now you've got 6% tax surcharge on £2 million, which is £120,000 of a tax bill. And then every 10 years, you create this compounding problem because your properties are going up in value, and every 10 years you still have the 6% surcharge that you've got to pay. So therefore, again, it's just not a tax efficient vehicle, and this is one of the main reasons why we don't recommend to our clients using a normal trust is the best thing to do for the avoidance of an inheritance tax. For sure, you can definitely pass the assets on to your loved ones and beneficiaries through the use of a trust and not pay the inheritance tax, but you have the additional taxes which most people are unaware of. So hopefully this video will help you to understand the nuances of putting it into trust and actually why there's a better alternative. So what is that better alternative that you might be asking? Well, the better alternative, and what we usually do with our clients, is we effectively recommend the use of what we call smart company structures, and otherwise termed a family investment company. Now, from a high level, what is a family investment company? Well, it's a vehicle that we set up where we buy properties in a limited company, and we have a specific share structure, and we have alphabet shares, and we distribute share classes in the use of freezer shares, and also a discretionary trust with growth shares. Now, the discretionary trust is the mechanism that solves the inheritance tax problem for our property investors, so that all the capital in the portfolio as it grows over the years, so that capital gain sits outside of the estate of the owners and the directors of the limited company. So everything's pushed outside of your estate, so therefore upon death and upon demise, what happens when you pass the assets on within that limited company, if it has a smart family investment company structure with a discretionary trust with growth shares, effectively all of the capital that sits in those properties in terms of the growth won't be exposed to inheritance tax. It will be shielded from inheritance tax because the discretionary trust and the capital is not inside your estate. So from a high level, that's kind of how that works. And the way that it's underwritten and the way that we've put together and formalized that structure allows us to get lending at 98% of mortgage lenders. Okay, so therefore, again, we're looking to get the same benefits of inheritance tax, solve the 40% inheritance tax problem, but create a vehicle which is actually tax efficient, where we can draw out money in a much more tax efficient way from the limited smart share structure, and also not have the problem of the capital gain when we sell the properties, because we're exchanging the capital gain for a corporation tax, and corporation tax at the moment is anywhere between 19 to 25%. And obviously, as a limited company owner, you can massage your profits on the balance sheet to reduce your corporation tax liability. And again, even if you had to pay between 19 and 25% on the sale or disposal of an asset for that accounting year, is still better than a 28% capital gains tax if the property was in a trust, and you still get the benefits of obviously the inheritance tax savings of 40%. 40%. And then there's a dividend allowance that you can use through using multiple shareholders within that vehicle. So again, you can basically become more income tax efficient. And then lastly, that this limited company, as it grows in value, the shares are frozen at the day we incorporate, and therefore effectively our share premium never grows more than being worth 1 penny if we set it up on the day of incorporation. Because when we allocate the shares and we set up the smart company, we freeze the shares at just 1 pence. So effectively, because they're frozen at 1 pence, if these properties go from being worth 1 million and then they're worth 2 million in 10 years time, well, the shares are still only valued at a penny when they were set up, based on the number of shares you had. So if you had 4,900 shares and you owned 4,900, let's say that was Class A shares, at a penny is £49. The shares can never be worth more than £49, even if the property portfolio grows to be worth £1 billion in the future. So again, you offset all of these capital gains tax problems, you have an income tax efficient structure, you don't have a tax surcharge every 10 years at 6% of the value of the properties, which you would in a normal trust. And the benefit of the smart companies, you still get the same benefits as a normal trust, where you shield all of your inheritance tax and save the 40% for your loved ones and your beneficiaries, and at the same time it allows you flexibility to get mortgages against the properties at competitive rates, which obviously the trust doesn't do. So in a nutshell, I hope you found this video useful. That's the main reason why we use smart company structures and family investment companies, as opposed to choosing and electing to transfer our properties into a normal trust, to get around the nuances that I've spoken about today. Now, if you liked this video, please go ahead and hit that like button. Also, comment in the comment section down below if you've got any questions about inheritance tax and how to utilize the structures that I've talked about. Feel free to comment down below, and myself or someone from my team will go in and answer those questions. And also, if you're a property investor yourself and you've set up something that you think is a very good inheritance tax vehicle, then please, let us know what you're doing in the comment section and why you chose to do that. It'd be interesting for everybody to see. And lastly, if you haven't already and you're new to my channel, please go ahead and hit that bell icon so that you can subscribe to new and upcoming content.